In Part 1, we explored the global energy transition, why renewable energy matters, and why it represents one of the most important economic shifts of our time. In this video, Part 2, we'll focus on how smart investors actually participate in this transition. And, just as importantly, how they manage risk. Because, opportunity without discipline is not investing. It's speculation. There is no single path into renewable energy investing. Different approaches suit different investors, depending on experience, capital, and risk tolerance. The most direct method is buying individual stocks. These include manufacturers of solar panels and wind turbines, developers that build and operate renewable projects, and utility companies transitioning from fossil fuels to clean energy. The advantage of individual stocks is clear. If you pick a winner, the upside can be significant. But the risk is also higher. A single company's fortunes can swing dramatically due to competition, policy changes, or technological missteps. This approach is best suited for investors willing to do deep research on specific businesses. A simpler and more diversified option is exchange-traded funds, or ETFs. Clean energy ETFs hold baskets of many companies, sometimes dozens or even hundreds, across solar, wind, storage, and related technologies. The main benefit is diversification. No single failure can derail your entire investment. ETFs are often ideal for beginners or investors who want broad exposure without having to pick individual winners. A third and increasingly important area is energy storage and batteries. Storage unlocks the full potential of renewable energy. It allows power generated when the sun is shining or the wind is blowing to be used later when demand is high. As electric vehicles expand and more renewable power connects to the grid, demand for storage will grow dramatically. Investing in storage can offer higher growth, but it is a more focused bet than a broad ETF. For more sophisticated, long-term investors, there is infrastructure and project finance. This involves investing directly in physical assets, solar farms, wind projects, or portfolios of renewable infrastructure. These investments often provide steady, predictable cash flows over many years. They are less liquid and require larger capital commitments, but they can offer stable, inflation-protected returns. Finally, there are emerging markets. Regions like Africa, Southeast Asia, and Latin America represent enormous growth opportunities, but they also carry higher political, regulatory, and currency risks. Each of these paths offers a different balance of risk and reward. So why are investors paying so much attention to renewable energy? Well, one of the most important reasons is falling costs. The manufacturing of solar panels and wind turbines has become vastly more efficient. Economies of scale, technological improvements, and competition have driven prices down year after year. As a result, building new renewable projects today is far cheaper than it was even a decade ago, and the electricity they produce is often cheaper than fossil fuels. This cost advantage is fundamental. It means renewable projects can compete on price alone, without relying heavily on subsidies, making their business models more durable. Another major financial benefit is predictable revenue. Many large, renewable projects operate under long-term contracts called power purchase agreements, or PPAs. Under a PPA, a utility or large corporation agrees to buy electricity at a fixed price for 15, 20, or even 25 years. For investors, this stability is extremely attractive. It transforms energy projects into assets with predictable, long-term cash flows. Renewable assets can also provide inflation protection. Some PPAs include clauses that allow prices to rise with inflation. And because solar and wind have zero fuel costs, they are not exposed to volatile commodity prices. Finally, renewables can improve portfolio diversification. Their returns are often driven by long-term structural factors, policy, technology, infrastructure, rather than short-term economic cycles. This can reduce overall portfolio volatility over time. Despite the opportunity, renewable energy is not risk-free. The first major risk is policy and regulatory risk. Many projects still benefit from subsidies, tax credits, or mandates. These policies can change with political cycles. A sudden shift in regulation can significantly impact profitability. Second is technology risk. A company that leads today may be overtaken tomorrow by a cheaper or more efficient technology. This is the natural creative destruction of fast-growing industries. Third is capital intensity. renewable projects often require massive upfront investment and long payback periods. Companies may take on significant debt to finance growth. Rising interest rates or construction delays can squeeze returns. There are also grid and infrastructure constraints. Power is only valuable if it can be delivered. Without sufficient transmission capacity, even the best projects can stall. Finally, there is market volatility. Clean energy stocks can swing sharply based on news, sentiment, or earnings. This is not a space for investors seeking smooth short-term returns. This is where discipline matters. Believing in clean energy is not enough. Smart investors evaluate opportunities on financial fundamentals. They ask, is the company profitable or on a credible path to profitability? How dependent is it on subsidies? Does it have long-term contracts securing revenue? What is its competitive advantage? Are debt levels manageable? Is cash flow stable and growing? For project developers, investors examine the pipeline. Are projects in strong wind or solar locations? Are permits likely? Are buyers secured? Numbers matter more than narratives. Renewable energy investing is not a short-term trade, it is a bet on a multi-decade transformation. A sensible strategy emphasizes balance. Avoid all-in bets on single stocks or single technologies. Diversification is your best defense against uncertainty. For many investors, a strong starting point is a broad renewable energy ETF as a core holding. From there, selective exposure to high-quality companies, storage technologies, or infrastructure assets can enhance returns. Strategy should always match your personal situation. If you're young with decades ahead, you can afford more growth and volatility. If you're closer to retirement, stable, income-generating assets may matter more. Reinvest dividends, let compounding work, and above all, be patient. Renewable energy represents one of the most significant economic transformations of our lifetime. The opportunity is massive, the challenges are real, but the greatest risk may not be volatility, it may be failing to participate at all. When history looks back on the global energy transition, where will your portfolio have stood? Think long-term, diversify wisely, stay informed.